I'm going to discuss task 4.6 with you. I've set out the explanation by filling in what it is all about. If you look at this exercise and you need to work out depreciation, you realize that in this exercise we start off with vehicles at a cost price of 150,000. But vehicles, the method that we depreciate vehicles is on book value, carry value, and we do it at 25% per year. But the old vehicles will be used the whole year. So I want you to get into the method of indicating old, new, because we're going to also have sold. So I normally would want old right at the end, but it doesn't matter. We go old, new, sold. 150 minus the accumulated depreciation. Why? Because it's the diminishing balance. Diminishing balance means on book value. What is book value? Book value is cost price minus accumulated depreciation. So if you take the cost price of your vehicle and you take the accumulated depreciation of the vehicle for the 1st of March, then that's from the last year. So that's what you should remove to work out what would be the depreciation for this year. Then you will see that we bought a new one on the 31st on credit because it says creditors. Now we only had it for no, you can't count December because it's the end of December. So you had it for January. You used it for January and February, 2 months. And that would be the depreciation on the new one. So what is the total depreciation that we need to take into account at the end of the year for vehicles? And that would be those two amounts added together that will give you the total. Now let's look at equipment. Equipment, the method that we use to depreciate equipment at the end of a year is 20% on cost price. So it doesn't matter what depreciation was written off previously. We will work with the original cost price. Again, old and new. But you will see that you have two new pieces of equipment. The one was bought on cash on the 31st of March, which is the end of the first month. So we haven't used it in March. We only start using it from April. So that's why we have been using this piece of equipment for 11 months only. And then we bought another new one on credit on the 1st of June. So we are using it for the whole of June, July, August, September, October, November, December, January, February, 9 months. If you work it out, you get 300. Then you add the 3 together to give you the total amount of depreciation for the year. And now, once you've done your calculation and you've set it out like that, once you've done that, what do? You go to your double entry. Remember, this doesn't change. This only needed to be balanced. Why? Because your fixed assets keep balanced. Assets and liabilities will be balanced at the end of the year. The only thing you need to take into consideration is the depreciation. Accumulated depreciation credit, depreciation debit. Accumulated depreciation credit for equipment, depreciation debit. So I'm sorry, you will see that there's no depreciation account, but you would use only one depreciation account at the end of the year. And for both the accumulated depreciation on equipment and vehicles. And you add up the depreciation. So on depreciation, if I can just indicate it here, if you have depreciation here, you will have your total for vehicles here, and then you will have the total for equipment here. At the end of a financial period, this will be closed off to profit and loss account, the total of the two. Okay, we'll go to profit and loss, whereas your assets, your B accounts, will all be balanced. Okay, that's the end of this exercise 4.6.